Indiacharts, the truth about the markets.
Indiacharts publishes Nifty daily video updates, the weekly Elliott weight outlook, and the long-short report covering all asset classes.
After dropping almost 100 points on overnight Qs, the Nifty closed 60 points positive today. And these are interesting points, especially for market analysts who are trying to figure things out. One, purely looking at what the charts are telling you and trying to believe in what they are really trying to tell you versus the news flow. And that's why I'm really loving it, because the charts are doing exactly what they should and the news flow is coming and going. So I try to discount that based on, again, chart signals from the news flow itself. So if you're talking about bond markets, you're talking about the banking index, you're talking about the banking sector in the US or any other news flow, open the chart related to that particular news item, study it specifically from an Elliott wave perspective, because that is the only science that allows you to understand behavior. Behavior is the rare animal. You want to understand mass psychology, how the crowd is behaving, which way are they headed, and are they really done heading in a particular direction as far as they can with no headroom really left. Very, very important decision that allows you to discount news flows and markets in the right way. And if you're able to do it, you have a raging bull run for yourself. There are times where you can go wrong, get caught into narratives and permas. It's human behavior. It happens to everybody. And which is why you have an entire subject known as behavioral finance that deals with these kind of issues. But the sooner you sort them out, figure out your own personality trait, and then put together the key steps you need to take, the variables you need to watch so that you don't make behavioral finance mistakes, and then you are set to go on a long journey to successful trading and investing. So this is the nutshell, and I think that's sort of what we've ended up seeing now. If I talk about the current movement of the last 2 days in wave theory language, then I would end up saying the market fell for a day until today's intraday low in 3 waves, and then rallied right past those highs. And when it falls in 3 waves, it simply means that the fall is a corrective pattern in nature, and that the rise is impulsive. Now we've closed only marginally above 19,600. The last 3-wave fall of slightly one step bigger on the daily chart, not just the hourly chart. 61% retracement is at around 19,650. That will be another level beyond which we say, okay, fine, this cannot be an X wave. But if I look at the hourly chart of the Nifty, we have got breakouts today from the minor falling channel for the last 2-day dip, and then a broader channel of the last 2-week dip. Both the falling channels, trend lines were surpassed in one shot above 19,600. We also have the highest call writing in 19,600 ahead of tomorrow's expiration, which coincides with an RBI meeting. So here you have an event again, which relates again to interest rates, currency, and we can look at how those trends are in those individual markets. But a lot of news flow has really come in around these different aspects over the last 10-15 days, which I'll really get into. But let me quickly reflect on what I think of the Nifty. I think the 2-week correction is mostly over. Given this breakout, we are waiting for this 19,600 and then 19,650 to surpass as confirmation points. But when you drop to a level as low as 19,290, I actually see the risk reward, the potential support over there, at least for an immediate blip, bounce back, and take positions according to that. Because when the risk reward is good, when you know where your stop loss is, that's when you need to act. That is the timing of the whole thing. You can always manage risk when you take care of things at the right level. You can position size, which means you don't need to buy everything. You can spread it out over a period of days, and that also sorts things out, so you don't really end up losing too much if things go against you. But having critical levels, having right points of waiting are important things. In fact, and how do you figure all that out? You use key indicators, and all these indicators now I've made available through the Strike platform to each and everyone who wants to use them. Till yesterday it was like, okay, it's your private indicator, or the sentiment indicators that we use, whether it's positioning, whether it's AD ratios. I think nobody has in the country. Nobody has advanced decline ratio charts, and we've plotted them. I have history all the way to 2000. Right now, the Strike software is showing 2012. I'm pushing my team to make it available all the way to 2000 because we have the data and we simply need to show you the plot. So looking at those wide ranges of data, you actually able to study how a particular indicator behaved in a previous bull and bear market, and then be able to place it in the same context. And these indicators can be of different time horizons. Like the 40-day advanced decline is useful for medium to long term, and the 20-day can be used for much shorter term, medium term cycles. So based on what time horizon you are in, there are indicators for you out there which can be used. And the RMI itself, which is the Rohit momentum indicator, use it on the time frame you want. Use a quarterly chart if you want quarterly cycles. It can apply for many years. And use an hourly chart if the next 4 to 5 days only interests you. And so today in the last hour, the RMI did give a bullish crossover. And I've actually created in live mode something that's important, because I like to trade on the hour or on the day, which means that if a signal is generated based on today's closing, I want to buy today itself and not tomorrow morning. I did a historical back test very long back when I was running a model based trading portfolio on Nifty called Nifty Thrifty at Sherkhan. And when I did the back testing, one of the funny things I ended up testing is, okay, what if I buy on the close, or what if I buy tomorrow morning? What would be the difference in return? The difference was almost 50%. That means the CAGR, if it is 30% on one method, it will be 15% on the other method. That means half the returns were given away in overnight gaps when I ran the test on a 20-year period of data. So you can just imagine the amount of returns you're giving up by not acting quick enough, which is why live signals, which means a signal that is about to come even on the daily chart, is important, because then I can actually trade or take action in the last 15 minutes of the day and be ahead of the curve, not wait for tomorrow morning's gap up action. And similarly, some signals on, if you're using an hourly chart now, the hourly signal only today came after 2:30. The market didn't move, and then by 3, it's only after 3 to 3:30, that last half an hour, where it started to flash that a new hourly buy signal is actually coming. Now, do I wait for it to come till 3:30, or do I buy it in the morning, or do I buy now? That becomes the question mark, and that is where watching indicators in a live market is sometimes useful when you're positioning very short term. So that gets you excited when a trend moves, and then it also confirms from a wave perspective that yes, the fall was 3 waves and it is bouncing back. It's not, the fall was an impulse, which means the fall was corrective and the rise is going to be the trend, and therefore that is what it is. And we've made a slightly higher low. So even on a Dow theory basis, and we do have Dow theory scanners now in Strike as well. So if you've not used the software, simply go to scanners and look at Dow trend scanner, and you'll find that you can actually check that out. If something makes a higher high, higher low, that also in live mode we can know what is making it right now. In the last hour of the day, the Nifty made a higher high. It surpassed the last 2 days high. So it made a higher bottom intraday today, and then made a higher high. That gives you a higher high, higher low Dow theory trend reversal confirmation. Now, Dow theory trend reversals on a daily chart can actually occur faster than the RMI itself. So you can get 2 degrees of confirmation, right? One is the Dow theory and second is the RMI, and you could actually act on both with different quantities. And so that is what we call as position sizing. You don't buy everything on one indicator. You spread it out across different time horizons, different indicators and different price levels. And therefore, on additional confirmation, as price moves in your favor, you actually end up adding on the way up, and that is a very nice way of managing risk. So even if it gives back, say for example, what happened yesterday, the hourly RMI went into sell mode during the day as it was falling after the first 1 hour. And in the second hour, when it did do that, if you assigned say a 20-25% weightage to the indicator itself, you could have reduced your positioning to some extent, waited for it to pull back and then add it back. Those are the kind of strategies you can actually build once you start using a handful of indicators. And I don't use more than 5-6, which is why I call it the Rohit setup. You can simply click on Rohit setup in the Strike software and it will show you those 4-5 things, which is like the Bollinger Band, RMI, 20 DMA, 40 DMA and so on. I can add an additional RSI to it, which is not there. Visually, you can add it because it's the trading view indicator list is there, and you can just add that on top of the chart, and there you have the setup. Now all you need to do is execute. Execution is everything when it comes to markets. That is what it's going to be all about. So I think this pullback is done. We are getting signals of confirmation that the uptrend is starting. Higher high, higher low first confirmation. Daily RMI will come with a lag. Hourly is already come again for a second time from a higher bottom, which is what makes it interesting. And now we'll watch out whether we get past 19,650 and then we are off to new highs is my personal view, because after that, once you cross 61% of the last 3-way fall, I don't think there should be much more room for doubt. I mean, things can always go wrong, but I usually drop most of the doubts at that level. So after that, I'll look for going past 19,990, which means above 20K, and that's going to be the outlook for the days and weeks ahead. How much above is something we explore in greater detail in the weekend with Indiacharts. So I'll leave that for there. But let me get into some of the concerns and how they've really been coming out. I mean, since my last YouTube video, which I recorded and I published a little later, after the Federal Reserve meeting, a lot has happened, right? The Fed Reserve meeting itself should have been about the bond market. I thought that sort of, prior to his announcements, we were pretty much in a place where the inflation data was cooling, the growth data was, also the employment data, for example, was also slowing. I mean, it was not growing as rapidly, and so that was taken by the market as that fine. This may be an early sign that yields can drop and the dollar can drop, and that's what was happening as we went into the Fed's meet. But once it was done, the bond market did start to bounce back a bit because there was some worries that, well, he still has one more hike on the table. And then two things happened, right? So even though he has only one more hike, so we can say, okay, fine, that's one more, we can discount it and bond yields can start falling again. But then you got the US downgrade. The downgrade of US credit started creating some ripples across markets, and that's sort of how this initial correction started. Not for India. India was already correcting ahead of that, but US markets definitely got a jolt once that happened. So that was the initial jolt. It pushed prices back to the 20-day average, and for the Nifty, it actually pushed it further down to the 40-day. Now the US markets eventually got there, and we'll see how. So the first knee-jerk reaction around the US debts, debt downgrade is pretty amusing, because when you look back at all the way when the last downgrade happened, which is 2011, which is after the GFC, almost 2 years later, which is why today on Twitter I've actually written, and there's somebody at this moment trying to comment back at me that, how can you joke that, rating agencies are backward looking. But that is just the history of it. We have seen companies go down and then get downgraded by the rating agencies after they've gone down, after they've lost half their value, much later than than action should have actually been taken. And you might even see the same in the case of the Adani group right now. I don't know how many rating agencies downgraded after the Heidenberg reports, how many downgraded before the Heidenberg report, and so on and so forth. So GFC happens, whole world crashes, banks go down, and then the rating downgrades start. For individual banks also, they started in late 2009, and then for the US government, it ended up happening in 2011, almost 2 years after the GFC. That caused the short-term knee-jerk reaction, a pretty big jolt, in fact, at that point of time, and then markets simply continued higher. Now, the jolt at that point of time was even bigger because, the ratings meant something, because government bonds essentially needed to be AAA rated if they had to be accepted as collateral. That was the rule. Because the rule was AAA or not acceptable under this category, and so that meant that suddenly under that category, US bonds would not be accepted, and they are now AA based on the S&P 500 ratings. But that was changed, I think, within months, and the new reading is AAA or government bonds. So which means it doesn't matter what the rating of the government bond is, it's still going to be accepted as collateral because it's pristine. And so that is why that part of the reaction is missing from the markets this time, because it doesn't really affect your ability to park bonds with the bank as pristine capital, because the rating has no meaning anymore according to the change in ruling. But it does send out a warning signal to governments, boss, you're borrowing too much, which they already know to some extent, and they're already on a plan of inflating away the debt. And if that's not what you understood from what they've been doing, I've written this in great detail in the long short reports over the last year, and the current one also explained it once more, why we think markets are going to behave the way they are behaving right now. So without going into too much detail there, we'll just leave it at the idea that it doesn't matter anymore. Okay, government bonds are not going to default, they're going to be inflated away. Okay, unless something goes wrong. You'd need something wrong means some unexpected calamity, something like a war, something like, well, we already had COVID, so I don't know if I can say another epidemic of sorts, or something that we don't really expect, something out of the blue, a black swan as we call it. A black swan is really got to be something out of the blue. It just can't be, oh, this will happen, banks will collapse, black swan. They already know that. The Fed has got your back. So that's what happened with the US downgrade of their own credit. It sends out a warning signal to everyone. It in fact, it should push the dollar down. That would be the immediate impact I would expect. And we probably saw a bit of a dollar dip, after that, even though bond yields were rising, because it goes both ways. But then, if bond yields are rising, that is knocking on the door. So that is surely a risk, if people don't start buying up bonds. And do we really need a crisis for bonds to rise? Again, a very, very long discussion. But we have seen what was looking like a bond rally go into a bond sell-off. But despite that announcement, bond yields did not, or at least bond prices did not make a new low compared to the low they've made a year back. Okay, so they didn't make a new low despite this. So that also tells you something. The reaction this time has been more muted when it comes to that downgrade. Now, that was a couple of days ago. That event was almost discounted. It looked like by Friday, markets didn't fall too much. Maybe we'll take support here. And then wake up Monday morning, you get downgrades of the banking sector. Now, this was a second one out of the blue. So you didn't just get a Fitch downgrade, but now you have Moody's downgrading the banking sector. And now this is also amusing of sorts, and points to the same thing. Are they early or are they late? We'll only come to know later. But right now, I think based on everything that has happened and my reading of charts, like I mentioned in the beginning, I've written about the KBW Bank Index. Large ABC, you've achieved C equal to A, which means in a large multi-month, multi-quarter ABC decline, the third wave and the first wave have achieved equality and retraced 70 to 80% of the gains that they had made in post-COVID rally. So when you have fallen back that much, and after that fall, the rating agency wants to come in and now downgrade your banking sector. And that also after that ABC decline, which was in March of 2023, the Fed has come out and said, fine, here's an open window. If you need cash, you can borrow directly from it. So cash is available for everybody who needs it. And the Fed is ready to either bail out the banks or merge them with somebody else. We've already seen a couple of such mergers. So when a Moody's downgrade happens, either they're pointing to more such mergers coming, or they're simply trying to say, well, we've done our job of scanning all the banks for what's right and what's wrong. And after all, if bond yields are rising, which they are right now, then if there is any risk on these books, we might as well highlight it before another crisis happens. So sort of they're doing their job. They're doing their job after yields have gone up and after those bond books are going to appear to be getting decimated, which means they need to be borrowing more, which they can since the Fed is providing that liquidity. But yes, the rating agency is just doing their job of highlighting the fact that rising bond yields are now going to hurt these set of banks. If yields go up further, we'll probably give you a second list and a third list, and that's going to be the process. Now, are we going to really let bond yields go on and on higher and higher beyond this point? Now, that's a question for the central bank and for the US Treasury to really mull over. I'm sure they've mulled it over. Let's come back to that. But here, as of now, the downgrades of the banking sector just predicated on this idea that yes, yields are rising. We have an issue, but we also have backing of the Fed, and therefore it's not going to be a banking failure. Which is why what you saw, look at the intraday action. One is you have completed the previous bear market from a wave perspective. You started a recovery in the banking sector, something I've been predicting for the last couple of weeks. And yesterday, even after this downgrade intraday, the bank index, KBW or anyone you take, opened lower, gapped down, and then went all the way down, recovered all the losses, and then closed higher than where it opened, forming what we call in candlestick terms a hammer. A hammer is a candlestick pattern where all the selling gets absorbed and then you close higher, which shows that buying is strong. Buyers are strong at lower levels. Not going to let it happen. And it's a potential sign of a bottom. So we have signed that, well, it was just a panic reaction. We've bottomed and we might just continue higher because we ended up closing above the 20-day average. We didn't even break that on the bank index. Whereas the other indices took all this news flow and have gone back to their lower Bollinger Bands, whether it's the S&P, Nasdaq, Russell, they're all back there at support levels from where typically they should rally unless the world is going to come to an end, which it's not, so which means it's going to rally. So that's my view. US markets are set up for another rally to new 52-week highs. Can't say all time yet, but new 52-week highs in the coming weeks, which would also aid a rally in India. We're also seeing a similar recovery in Europe right now as I speak, so which means even European, Italian bank windfall tax is sort of absorbed. Now that is something I've not been able to study because Europe is usually off our radar. Many years ago, I used to read a lot on it when the Greek and other problems were in highlight, but after that I've slowly gone off the books. I'm not really studying Europe in so much detail to be able to comment on what they've just done. But the fact is, when we look at the charts of Europe, and I posted, I think, a chart of the Euro Stocks 50 yesterday, probably in the insiders, maybe not in the public space. It's a long leading diagonal, okay, multiple impulse waves overlapping with each other, getting shorter, but narrowly consolidating on the weekly chart, waiting for another breakout setup to the upside. That is what it looks like. I mean, so as much as there's everything wrong with Europe, the chart suggests that there's nothing wrong with Europe. It's just rallied post the lows of Jan, and now it's consolidating and waiting for the next trigger to continue higher, not even down. It doesn't look like, at least right now, the 40-week average is holding, 23% retracement is holding. No sign of really a breakdown to think that something should happen, but a lot of short-term volatility. So with all this news flow from Fed to these rating movements and this windfall tax, you've got a lot of volatility around these indices, but they're not really making lower lows. Classic Dow theory downtrend, not happening yet. And in fact, like I mentioned, Russell, Nasdaq all just pulled back, made a higher low on the weekly chart, and most probably should continue higher from here unless there is some new evidence or new data. So no matter what happens, no matter what hits these markets in terms of near-term news flow, it's really getting absorbed. Whereas not getting absorbed is the bond market itself, which, like I said, is knocking on the doors of trying to break the lows that it made last year, the bond prices, that is. Bond yields also trying to break past that 4.1, 4.2% for the 10-year GSEC, 10-year notes, that is, and not yet there. And so since it's not yet there, what has happened in the meantime is we have a record short position. If you actually add up all the shorts across the bond market, it will be an all-time high. It may vary from the 10-year to the 30-year because 10-year was highest some time back, then it's reduced, and the 30-year is adding up, and then the 2-year will have it. But if you add it all three together, there was a chart I saw yesterday which someone sent me, I think, or today morning on Twitter, which shows highest short. So I said, brilliant. I mean, if that is the case, the setup is really for a huge short covering rally to happen. What does it need? The same trigger that was there last month, which is inflation data was falling and yields had started to fall. But all these events, all these announcements from the Fed to the rating downgrades have actually pushed yields back up and created that fear of breaking away. But they haven't broken past the previous high. So this time the news is not causing that bad a reaction in the bond market. In fact, it's just creating those shorts back to records and keeping them there. And if there's the slightest positive news, if all this gets absorbed, and imagine inflation data, which is coming Thursday night, is again good, again moving in the direction as expected, and it's already been, the core inflation's already headed lower 2 weeks back. Now again, you look for this month's data, and if it's favorable, then somewhere we are getting to the point where a bond market rally is going to get triggered. That is my main point. You have a huge short in the US bond market. You already had the huge short in the US equity market, which is 50% unwound, not even 50, I would say 30% unwound, because, well, you can say 50. You'd cross 400,000 contracts. Now you're at around 200,000 plus contracts. So 50% unwound, 50% still on the table in terms of short, but the bond market is still at record. Both are due for short covering. So you get a bond and equity market rally. That is what I think will be the end result of all of this, against all expectations of bonds go up, equities go down narrative, which I think will fall on its face. And I've explained that in detail in the weekend with Indiacharts. Again, can't go into that much detail here. If you like, you go 2-3 episodes back and listen to it, where I've discussed comparisons with similar, and the long short report looks at the 40s, and I've discussed the 80s. We've looked at the patterns of bonds, yields, equities, inflation, all of them correlating in different time periods, different economic environments, to explain why this will happen in a different way than it did in 2000 and 2008. So that's our expectation, a complete due change of how all this ends up, despite all the panic in bond markets, despite the push up in the dollar. The dollar index peaked 1 year ago at almost 116, 17. Since then, it's fallen below 100. It's trying to get back. The 20-week average is 102.8. It couldn't get back above that last week. It has been trying for the last 2 days. We'll watch. And if it fails, then our bearish dollar view is still intact. Now, in the meantime, the rupee has been a pain because, unlike the dollar index, the USD INR has not been really able to fall much. And that's been true with a lot of emerging market currencies. They haven't really rallied as hard as they should have in a dollar weak environment, probably because there were a lot of deviations or divergent moves across different currency baskets. Like you still had the yen falling, you still had the yuan falling, the Chinese yuan. And many emerging market currencies like the Brazilian real and all, or the Australian dollar, are not strengthening as much as they would have. So most of the dollar rally was driven mostly by the British pound, which was leading the way, and to some extent the euro, which was backing it up. but the British pound was the real leader at this point of time. We haven't seen it happen across the board, which is probably why the USD-INR is also slightly flattish apart from any RBI intervention conspiracy theory stuff. And the RBI may try, sure, they need to build up their reserves and they're doing that consistently. One more reason why it's stuck between this range. But eventually, I still feel the rupee, as long as it can't get past 83 against the USD, is going to strengthen, which means USD-INR going down. And that is the likely pattern. Let's see how it responds around the RBI meet. A lot will depend because you know what happens. Say the RBI does the unexpected, which is cut rates, which I think they should, and I wish they will, but I'm usually wrong about the RBI, and so maybe they'll do nothing or just barely indicate they do something. The USD-INR would shoot up first, right? Oh, they are cutting rates. The rupee should weaken. And once that flash crash is done, you'll probably see it turn and then a steadier move in the other way, because when you get a bond market rally, it'll actually end up attracting global money more than ever. And when that happens, then the rupee starts to strengthen. So one thing is the short-term reaction to something like that, rate cuts. And then there's the medium to longer-term reaction, because my long-term view continues to remain that interest rates in India are going to go far, far lower than most people can imagine, even if they don't go that much lower in other parts of the world, though there will be a bond market rally in the US. So very, very different divergent things that are going to happen, but net favorable to emerging markets and definitely excessively favorable to India. And so I'm sort of discounting the recent moves. Of course, I'm still closely monitoring. Bond yields haven't started falling. The DXY is still knocking at 102.8. But my sense is that I should be right. And let's see if that's what ends up happening. The next 2 days should be critical, both from getting inflation data from the US tomorrow and RBI's pronouncements on what it thinks of the situation. Even if it does nothing, that will be important in terms of giving us broad direction. So let's hope that happens tomorrow. And I'll leave you with these thoughts and this analysis for this week. Until next time, thank you.
Nothing in this podcast is investment advice. Views on financial markets are in good faith to expand your understanding of how markets work. Please consult a registered financial advisor for the same.
And yes, please share this podcast with everyone you think can benefit from this knowledge.